And good evening and welcome to this live stream event on the 16th of April 2019. It's great to have you on board. And those of you who don't know me, it's Martin North, the Principal of Digital Finance Analytics. It's now just after 8 o'clock, so we're actually going live properly now. And it's great to have you all on board. And thank you very much for spending time with me. So as normal, what I'm going to do is going to go through just a few slides to start with. So while we go through the slides, I'm not actually going to look at the live chat. So feel free to post comments, particularly if you want me to pick them up afterwards, but I'm not going to look at that. The reason I do that is because it's very hard to concentrate on the presentation and also look at the live chat at the same time. This is 16th of April and just a few agenda items. So this is the introduction. It doesn't take very long, but we always do this. Just a bit on the house rules. We'll talk about our models. We'll talk about a few key slides. I always think this is good because, DFA is all about data and information. Well, we'll give you some up-to-date information. Then we'll go into the questions and answers. I've got questions that people have asked me already, and we'll touch some of those, but also pick them off from the live stream as well. And I'll just briefly touch on the Harry Dent event. He's coming back again in a little while, so just on that. And then I'll sign off, and hopefully we'll finish by no later than 9:30 City time. Might be a little bit before, a little bit after, depending on how the discussion goes. And I should explain, I've got a runny nose tonight. Apologies for that. So if I start sniffing, just bear with me. So just in terms of house rules, as normal, this is not financial advice. I'm not allowed to give you financial advice. I'm not qualified to do it. I don't know your individual circumstances. So don't take it as such. This is my own views, my own opinions based on my own analysis and my own modelling. But hopefully people now have got a sense that I've got a bit of a feel of what's going on, and therefore it may be useful to you. But please don't take it as financial advice. It's not. Secondly, please play nice in the chat room. No racial slurs. We have had a few people in the past who stirred us up, and we had to actually moderate them. So this is a moderated stream. But if everybody plays nice, we get maximum value from the conversations. There are some really, really good conversations we've had in past chats, and I hope they'll have the same tonight. So no racial slurs. Just play nice, please. This is at the 16th of April 2019, so if you're watching this several years later, you'll know whether or not I was right. We'll see. I'm basing it on the information available to me, on my modelling and all my surveys as at today's date. Now, if you want to get my attention, please use @WalkTheWorld. There are lots of different conversations that goes on the live stream, and it's quite often the case that I don't follow every conversation. So if you use @WalkTheWorld, that will definitely get my attention. And now let me just touch on the core market model. So this is the way that the whole shebang works. We survey households. We put that information into our core market model, which includes 52,000 households plus a lot of other data. And that then drives all our research and analysis, mortgage industry reports, the blogs, and all of the stuff that we do on YouTube. So this is a fundamentally important thing to understand. This is based on data and information. It isn't just my opinion. And the 52,000 households, 4,000 a month, are right up to date. And we're including information right up to the end of last month. We slice and dice the data all sorts of different ways, by location, by segments, by geography, all of those things. And now let me just touch on the Reserve Bank minutes that came out today. Basically, weakness abounds. So they said that the GDP was only 0.2% higher and was below forecast. Growth in concessionary consumption very weak. The established housing market remained weak in recent weeks, and housing loan approvals materially below the levels seen a year earlier. This is all very negative from the Reserve Bank. So I think finally they're waking up to the fact that there's a lot of stuff going on. And these are three statements that I think are very important. The first was they said the lower level of interest rates could still be expected to support the economy through depreciation of the exchange rate and via reducing required interest payments on borrowing, freeing up cash for other expenditure. So the Reserve Bank is saying that let the exchange rate slide and potentially use interest rates as well. Secondly, members also discussed the scenario where inflation did not move any higher and unemployment trended up. noting that a decrease in the cash rate would likely be appropriate in those circumstances. So in other words, if we didn't see inflation moving up and if unemployment started to rise, then we would see a rate cut. So that's the clearest signal yet about what the Reserve Bank is thinking, a very big change from just a couple of months ago. And thirdly, then, members agreed that there was no strong case yet for a near-term adjustment in monetary policy. So in other words, don't expect a rate cut yet, but perhaps later in the year. These are very significant changes to the way that the Reserve Bank has been talking compared with previously when they were saying that the next rate move will be higher. Now, just in terms of my data, this is the annualised credit growth. It's still growing at 4.2%, housing for own occupation at 5.9%, investment credit at 0.9%. It's still quite a big deal, and, you know, let's be clear, housing credit is still growing faster than income growth, which means that households are getting ever more in debt. Now, in terms of new loan flows, it's quite interesting just watching what's happened over the last few months. So owner occupation is down 14.2% compared with a year ago. Investment inflows, this is new loans coming in, is down 28.9% over 12 months. Personal credit is also down, and owner-occupied and investment and personal credit together, all household is down 17.9%. So this shows you that the credit impulse is slowing, and then business credit is also down more than 10% compared with a year ago. So the annualized lending flows are a lot weaker. And as you may know, I keep arguing that it's about credit that drives home prices. So this all tells me home prices will slide further. Now, household confidence is also in the doldrums. We made a video on this quite recently. And this just shows you that all of our three main segments, the free affluents, those renting, and those mortgaged, are continuing to see household confidence waning. And in fact, they're all now below the 100 level. And what's interesting that the free affluents are the people who you would expect, because they've got property without mortgages, to be significantly more positive, but even they are now in negative territory. And that's another indicator, I think, of more difficulty ahead. Mortgage stress is still rising. We're at 31.6% of owner-occupied borrowers. The RBA reported that the debt to income, disposable income, is 189.6, very, very high, and almost one of the highest in the world. So very high levels of debt, very high levels of mortgage stress. And that's more than 1 million households in difficulty. The BBSW, this is the fund rate, has dropped. So previously we were seeing 20 basis points higher, but now since the early part of February, this is really now the result of the Fed easing rates, in other words, not lifting anymore and talking about rate cuts. That means that the banks now have a bit more to play with in terms of funding, and that's why we've seen some fixed rates dropping relative to recent times. The banks still have a problem, though, insofar that competition is driving these margins down, and therefore these rate moves won't necessarily solve their margin problem. Now, the financial sector is still down. It's down 3.5% over the last 12 months, so it's recovered a bit after Hayne when it was significantly lower, but it's still quite a bit down from a year ago. So people are still saying the bank's profitability is under pressure. And the budget, of course, came out. What's interesting is there's very little new spending, really. And there was some research done today that highlighted the fact that the budget made some heroic assumptions on all sorts of fronts. Won't go into that now, but it's quite important to understand that the budget, as presented, did have some big assumptions. But one of the ones that I think is really important is wages forecast. And this chart just keeps showing you how budget after budget keeps forecasting wage growth much higher than it really is. And we had the same again. So they're expecting in a couple of years' time wages growth to be at 3.5%, where in fact it's just over 2.1% now. It's pretty unlikely that we're going to see those wages growth figures materialise, because I don't see where the levers come from. Home prices, we continue to see home prices fall. This is from CoreLogic. Shows you that across Australia, on the upper quartile end, more than 10% down. The lower quartile, in other words, the cheaper properties, not so far of a drop. But you can see that pretty much across the centres of Darwin, Perth, Melbourne and Sydney, there are falls. There are rises still in areas of Adelaide and Hobart, although in fact now compared with earlier on, those are not so extended, and Canberra is still doing reasonably well. But what this tells you is that there's still significant downward momentum on the home prices. And CoreLogic today published this chart, which just showed you that the auction clearance rates are significantly down. 49% in the first quarter, which was a little bit higher than the previous quarter, as you can see from this chart. But the volumes are just so low that it really doesn't tell you a whole amount. So essentially what we're seeing is much lower volumes of properties sold at auction. There are some still being sold for private treaty, but overall transaction volumes and settlement volumes are something like 20 to 25% down from where they were previously. So there is little to show that essentially we're going to see a bounce based on the clearance rates, despite all the spruiking that's been going on, and particularly this weekend when people were saying that Sydney was at 69%. Well, we'll see. I suspect that it will correct. Remember, there are lots of examples where those auctions that weren't successful are not reported. And the other point to make is that quite often the price of settlement is now not being reported because the prices are a lot lower than people might first think. Now, I'm just going to touch on the scenarios and then we'll come back to the Q&A, so just give me another couple of minutes. Just so you know, our scenarios come off the back of our core market model. It's not just plucked out of the air, it's actually driven by all the data. And scenarios are just a way of thinking about the future. They may not be right, it's not a forecast, it's just showing you some of the sensitivities that we see in our modelling. But what it does over time is to show you how things are moving. So we basically have 5 scenarios: business as usual, things going to get better, not yet doomsday, Armageddon, which I call Ireland 2.0, and doomsday, Iceland 2.0. And for each of those, we look at what the Reserve Bank rate might be, what the unemployment rate might be, where mortgage stress might be, what bank losses may be, very importantly, where home prices peak to trough might be, and other things like what might they be doing. And I'll show you also the probability based on my modelling compared with last time. And I'm talking 24 to 36 months later. So this is not today, this is looking down the track a little. So business as usual, which is the Reserve Bank's strategy. In other words, if you follow what the Reserve Bank says is gospel, then essentially we would see unemployment 4.9 or thereabouts. I actually have taken that down slightly this time, that's why it's in yellow. But I'm still forecasting on the Reserve Bank modelling 10 to 15% home prices drops in Sydney and Melbourne, a little bit less in some other centres. But I only give this a 1% probability, the same as last time. So not really very big chance. The second is things going to get better. So here now we've got a higher unemployment rate. We've got the Reserve Bank cash rate at 1%. We've got some credit easing and some fiscal stimulus. And we see home prices down 15 to 20%. I give that a 10% weighting, the same as last time. The next one is not yet doomsday. So now the Reserve Bank cuts rates significantly more down to 0.5% over the next 2 to 3 years. Unemployment rate is above 6%. The mortgage stress goes to 36% of households. The bank losses are rising. And home prices are down 20 to 30% in the major centres over that period of time. In other words, we are somewhere between halfway and slightly over halfway down. In other words, more to come again. And there'll be one bank that will have difficulty in that scenario. Now, I give that now a 70% chance of... So this is my core scenario now and rate it 70%. Then we look at an Armageddon scenario. So rates go even lower, unemployment rises, mortgage stress rises, bank losses, and this effectively is created by an international crisis of some sort coming in over the top. It could be the US, it could be China, it could be Brexit or some combination of those or something else that we've not predicted. In that situation, there would be bail-ins and bail-outs and some sort of QE. I give that now a 16% chance. It was 21% last time. And the last scenario, which is basically Iceland, so the difference between Armageddon and doomsday is that in Armageddon we basically take interest rates down and bail out the banks. In Iceland's scenario, rates go lower, but we let the banks fail. And in that situation, we have significantly higher home prices, drops up to 80%. But I only give that a 3%. So you can see that what I'm saying is, based on my current modelling at the moment, I think that the international scenario is a little less aggressive in terms of risk compared with previously, whereas the not yet doomsday scenario, in other words 20 to 30%, is now becoming a much more firm scenario for me over the next 24 to 36 months. And I think it's highly unlikely that we're going to be able to get away with essentially escaping from that particular scenario. Okay, so let me now go back to the Q&A and pick up some of the questions, and I'm going back up to the top of the queue. Can they increase interest now? Are they making the inevitable bubble burst bigger? That's from Moet. Yeah, so I'm assuming you're talking here about the banks, are you, in terms of what they're thinking? I assume so. Yeah, the banks are doing some quite interesting things here. What they're actually doing is offering fixed rates for some types of loans, 3 years, 4 years, or 2 years. But not all the banks are doing precisely the same. And that's because of the funding costs. I showed you the BBSW, but they're not making those same reductions for the book. It's for new loans, right? So all of this is about attracting new customers, low credit risk customers, into the banks. So the banks are struggling to get new business. If they were to lift their mortgage rates on the existing book to support their margins, that's going to put a lot of extra pressure on households. And I don't think they're going to do that. I think we've seen a few out-of-cycle rate rises, but my own view is we won't see any more now. And in fact, I think that later in the year, the Reserve Bank will probably cut the cash rate, but that won't be translated through into the same degree of cut passed on to borrowers. I think the banks will pocket some of the difference. Okay, what's Joseph Wilkes? With apologies, I've arrived late today. Joseph, shame on you. Never mind, no problems. Are you going to get Morgan Kelly on to compare notes on Irish crash? No, Dai White. He doesn't do any public comments now. We actually did try a couple of times, but he's withdrawn from that. So no, we can't do that. We have tried, but we can't. But we did get another Irish guy, which you may have seen. He was talking about it from his perspective. Okay, Joytech22, if the RBA lowers rates, doesn't that also increase the burden on banks by increasing their own debt repayments? Wouldn't the debtor banks be passing on the rate? Well, it's a really interesting question. We start getting into what's called the lower bounds rate problem, right? So at a cash rate of 1.5%, if the Reserve Bank does drop the rate further down, the question is, will the banks be able to pass any or all of that on? There is a point at which they can't, because effectively of the way that the margin compression works. And there's been work done based in Japan and in a couple of other places too, looking at what happens as you approach 0% or indeed go negative. And essentially, the banks are unable to pass it through. So, for example, even if you look at the situation in Japan where the actual zero rate or below zero rate exists, the mortgage rates are not below zero. So there is a lower bound. In other words, there's limited downside available relating to mortgage rates, even if you went into QE mode or into negative interest rates, in my view. Joseph Wilkes just said, Barfoot and Thompson's Auckland clearance rates last week have improved a touch to 23% from 22% the week before. Right, well, that's pretty low. I think New Zealand is following us quite well at the moment. Can BitConnect play any role in the future of Australian finance? If not, could we arrange it? Be great for a few weeks. Interesting. I don't know really enough about that to be able to comment on it. Perhaps that's a conversation for another session, and we'll look at that in more detail later. Okay. What's your thoughts on Newcastle and the Central Coast? This is from Micah. Okay, so I've said consistently that I'm trying to get to do some regional analysis, and it's quite tough because of everything else that's going on at the moment. But there are signs now of declining values in and around Newcastle, the Central Coast, and also, for example, in Wollongong and in the areas around Wollongong. Between 6 and 9% looks like being the sort of movements down that we're seeing on average. It does vary between units and property, houses. There is, of course, a smaller stock of property there, but nevertheless, it looks to me as though the regional centres are starting to flow. And that's also true if you look down in the outskirts around Melbourne as well. And in some other centres, we're also seeing regional prices also going sideways. And I showed you the CoreLogic data that suggested perhaps the top end was sliding faster than the bottom end. That's certainly true, but I'm afraid regional centres are now beginning to move down. They didn't move up as quickly as Sydney or as extensively as Sydney, so they probably won't drop as far. But I think 6 to 9% is my view as to where things are at the moment. This is Len saying, me and the better three quarters have decided to sell and move to a regional town. We think Warwick or Bendigo. Have you any data that would sway the decision on picking a destination? Well, yeah, interestingly, if I take Bendigo and indeed Warwick too, existing property owners in those centres are actually struggling with mortgage stress quite a lot. So home values are actually not particularly robust there, in my view, and may well slide. So if you were thinking of a regional centre, what I'd say to you is you might want to wait a bit, because I think prices will slide further. One of the things I'm concerned about is people jumping into other markets thinking that prices have dropped, a few percent or 10% or whatever, and therefore it's a good time to buy. My argument is, if prices are continuing to slide, then you may do better not to buy, even to rent for a period of time perhaps, because essentially if you can buy later for cheaper, then you end up with a better outcome. So that's my own personal view as to how to deal with those scenarios. But, there might be circumstances that means you need to buy. But generally, there's no hurry. And I say this to first-time buyers too. Don't jump too quickly, because whilst prices may be down a little bit, there's no evidence yet that home price falls are slowing, despite what all the real estate guys are saying. Okay, and Nathaniel said, what do you think about Adelaide? It would seem to be going uppish and not following the trend of the other capitals. Well, I think you've got to be careful there. What are you basing the data on? And one of the things we've got to understand is that a lot of the data that's quoted is, one, average, two, it's very out of date, and three, some of the data in some of the online portals is definitely not updating as quickly as it used to. And of course, quite a lot of the a lot of the prices are actually not disclosed. So quite often we don't get a full story as to what prices are. Remember that settlement takes a couple of months on average, 2 to 3 months to come through. So settlement data, when it flows through, is really the point at which you get to know what the true values are. Now, I agree that prices in Adelaide are not falling as fast. But if you look carefully, some of the more recent data is suggesting they may be on the turn and indeed are falling. So I wouldn't necessarily argue that Adelaide is unique and different. People have said Adelaide and Hobart are the two unique and different markets. I think they're just slower. They will follow the rest of the trends, I think, simply because the same conditions with regard to credit availability exist in those markets. Prices are a lot lower. Property investors have tended to move from Sydney and Melbourne into some of those smaller markets, Canberra the same a little bit. But at some point, that's probably going to continue to slow if prices do start to slow. So I think it's a matter of timing rather than actually saying Adelaide is not going to be hit the same way. Now, Sean MC says, Canberra and other government towns are more resilient to downturns. Yeah, in a way, although around the time of an election, you might see some correction. And of course, the question also becomes if there are going to be job cuts in the public sector later, that could have an impact. But generally, Canberra market has been performing considerably stronger than many other markets. And in fact, if you look at the rental sector, we've now in the situation where you can get a cheaper rental in Sydney compared with Canberra, which is almost unheard of. So it's a big deal. Okay, Robert 86, I think. When do you think the inevitable recession will be? Well, I think, a recession is 2 negative quarters of growth, right? Now, we've been very lucky because the GDP number was supported last time around by very strong iron ore prices, because we export a lot to China, and also very significant public sector expenditure on various categories. Put those together, and that supported the economy. So I think technically it's probably unlikely for a quarter or two that we're actually going to see a GDP number negative. But you need to look at the component parts, and the thing to point out is that it's the household consumption problem that I'm seeing. A lot of households are finding it more and more difficult to make those mortgage repayments, and they are dialing down their expenditure. And that is already spilling out into retail. It's spilling out, of course, also into the construction sector, which is considerably down. We're seeing a lot of construction jobs now beginning to dissipate and disappear. And we also are seeing other small businesses that are sort of surrounding the household sector and the construction sector now in some difficulty. So we're already seeing some of the creeping signs of recession. But formally, I'm expecting to see a recession later rather than sooner, simply because of this iron ore miracle that's happening, particularly with China. Now, if China were to go off the boil, more so than perhaps the official numbers might suggest, that could change. We might also see other, like Brazil, come back on stream, for example, and start selling iron ore, and that could have an impact as well. But at the moment, my own view is that we're going to see a local problem more than an international problem, which is one of the reasons why my scenarios have morphed the way they have. And it's to do with household consumption, it's to do with wages being flat, it's to do with unemployment beginning to rise a little, and those feedback forces then creating effectively negative drag on the economy. Yusuf says, has anyone in the media or other economists tried to discredit your information? No, not really. Some of them will say things like, I'm over negative, but they don't actually explain why I'm over negative, and they don't get the difference between my research, which is household-based, and loan-based. So let's take the Reserve Bank data, for example. A lot of the Reserve Bank data is looking at individual loans. I'm looking at households, so total household finance, and I'm looking at the portfolio of loans that people have and their overall cash flows. There's nobody else really doing that. I mean, the official Hilda data is 2 years out of date, right? So that really doesn't tell you very much. And there aren't really many other people looking at the data in the same way. So no, I haven't really had anybody turn around and say it's complete rubbish. They would prefer it not to be true, but that's another story, I guess. Okay, what else have we got? This is from Milu. Do you think the slide has come close to an end in capital centres? Okay, so I think what you're asking here is, have we seen the home price falls effectively start bottoming out? I cannot see that we have, I'm afraid. I know that in some centres we've now got falls of 25% or more. That puts a lot of households in negative equity. And I know that also we've got more slides in broader areas. So effectively this correction is sort of spreading out from the Sydney, Melbourne, Perth axis into other areas. Now, the regional centres are not being impacted as heavily at the moment because they never went up as fast. But my argument is they probably will continue to experience some of that. So there is going to be, I think, some corrections in some rural areas as well. I'm also worried about the drought in rural areas because, of course, the drought, I think, is having a very significant impact in the number of centres now, particularly in rural areas. And that's going to put downward pressure on prices too. So essentially, I think you've got to assume the market is going to go sideways or down. And just to be clear, my own view is that this is not going to be a short, sharp correction and then a rebound, a bit like we saw the last couple of times. This is more likely to be a grind down, a slow sideways, and then probably more grind. And it could be looking at sort of 5 to 8 years before we start seeing momentum up. And people will argue, well, isn't there plenty of migration? Well, there is some migration, absolutely. But we've also got new properties still coming on the market, 200,000 a year. And we also know that quite a few migrants, when they come to Australia, they don't buy, they go into the rental sector. So I'm not sure that you can argue for migration to support home prices. Everybody needs to understand that it's credit availability that is driving home prices up. That's what happened over at least 10 years or so. Credit availability is still tighter. There's a little bit of sign now that there's a little loosening, but it's only at the margin. And as I showed you earlier on, the volumes of loans being written today are significantly down from 12 months ago, which is why I'm arguing that home prices will slide further. Okay. This is from Raymond. When will the government stop subtly and stealthily punishing the prudent saver who espouses a sensible household balance sheet? That's a really good question, yeah. I'm continually amazed that savers just seem to take it on the chin and say, oh, well, rates have dropped again, rates have dropped again. It is disgraceful that savers are essentially not earning a return on their deposits. Remember, of course, that there's a theoretical risk of deposit bail-in, right, in Australia, and we've discussed this in various other posts. So no way are the returns on deposits reflecting the risk on the deposit side of the balance sheet. And even now, a lot of banks are trimming deposits. Now, you can get some term deposit rates that are a little better now than they were a few months ago, but you have to shop around for those, and they're not always available. And of course, the thing about some of those term deposits, and you're locked in for a period of time, and that may not suit people. But no, many savers are finding it very difficult, and I reported the other week that many people, as they move into retirement, are finding that, one, they've still got a mortgage they didn't expect to have and they have to repay it, and two, the income that they're getting from their savings is a lot lower than people expected. In other words, the pool of savings that you need in superannuation to be able to survive retirement is significantly higher now than many people are actually accepting, simply because of the fact that you have such low rates of returns. And if the Reserve Bank cuts rates further, those returns are going down even further. That's disgraceful, because what it means then is people are forced into taking more risks with regard to other forms of investments. And that's one of the reasons why people look at other types of structures, but they have higher risks, and often the risks are not fully understood. So this is a really big deal, and I'm afraid that the 1/3 of households who haven't got a mortgage and are reliant on those savings are not vocal enough. I think there's a really important place to actually say to the politicians, this is not right, because essentially the Reserve Bank strategy at the moment, as I showed earlier on, is to cut rates, lower the exchange rate, and effectively allow the economy to continue to move based on even greater debt. That's folly, in my view. Okay, let's see what else is saying. And this is David Cormack. 6% of Sydney better off financially renting and investing in stock market rather than trying to pay off a mortgage. Yeah, that was EY today, wasn't it? Yeah, that was interesting research. But did you see that they assumed that you would effectively take a margin loan and use that margin loan to invest in the stock market? That's a highly risky strategy, in my view. And whilst it's fine when rates when stock market performance goes up, but if there is a significant correction, and remember that a decade ago we had a 40% correction in the stock market, you can get margin calls on those loans, and sometimes people find that they are stuck. So there are huge risks involved in effectively building wealth that way, but they are partly true. In a falling market, there is no capital growth, and therefore you've got to weigh up the costs of the mortgage and the repairs and the other issues relating to your property relative renting. And rentals are going backwards. So if you look around Sydney, rentals are cheaper today than they were a year ago. So there is a place for renting, I think, in the current environment. But it is not as clear-cut as simply saying, well, rent and then effectively build wealth through margin lending. I think that's a bit of a myopic view, in my view. Okay, Marty Pants says, what would you say a reasonable price would be at the moment for an average property based on gut instinct? Well, where would you like to buy is my question. If you are thinking of, somewhere close into the centre of Sydney, then an average price could well be $700, $800, $900, $1 million. If you're thinking of further out, then it will be considerably lower. I think you've got to be clearer about the question as to where you're looking. If you're looking in Melbourne, or if you're looking in Adelaide, potentially the prices will be somewhat lower as well. And then it depends on the type of property. Is it going to be in a very prestigious area? Is it going to have all the amenities like schools and those sorts of things? Because they will always have a premium. I did a post with Chris Bates, who's a mortgage advisor and wealth advisor, and he made the point, and I think it's worth repeating, that when you are thinking of buying in the current environment, you've got to think about buying the good properties in the good locations, because they are the ones that, one, will have more value now and potentially will hold their value. But even there, we may see some price falls. And therefore, it's hard to get a good average, because a lot of the property that's on the market at the moment is not prime. It's sort of second quality property. And in some cases, it's being put on the market because the people have no choice but to essentially do that. Okay, what else have we got? What do you think about New Zealand? I live in the town, this is from Lauren. I live in a town that people say is a growing town, 1.5 hours north of Auckland, almost solely construction jobs. Is this sustainable? No. You should watch some of the Joe Wilkes and DFA posts. Joe has driven around a few of these areas and spoken about it. The problem we've got is you've got the self-fulfilling prophecy of building properties, borrowing from the bank to build it, to flip it, to create value, to flip it, to create value, right? And that works in a rising market, but of course we're in the situation now, if you look at Auckland, where prices are beginning to go the other way. And the chances are that a lot of the property that's there will see its value slide. We also know that the construction rate is considerably higher than it needs to be. There's a much higher proportion of properties for sale than previously. And in fact, I think Joe made the point the other day that there's enough probably to keep the market happy for a year plus, even without any more construction at the moment. So we've got too much construction. We've got too many speculative purchasers trying to buy to flip, to buy to flip. And we've got too much bank lending to be able to support it. So I think it's an unsustainable view. And my view is that Auckland, whilst it looks quite interesting at the moment for some people, will continue to slide. And as Joe and I discussed the other day, big discussion, could it be that Auckland will be more expensive than Sydney in relative terms? Probably not. Joe Wilkes said, got the shock of my life today when the Herald in New Zealand published an article titled Property Armageddon. Aussie house prices could fall by 50%. Ah, well, there you go. 50%. That's even more than mine. Good to see your article on news.com today, forecasting around 50% drop in apartments and units in some areas of Sydney. Well, yeah, that's some double. Yeah, I've actually seen this. What amazes me is that the apartment prices, particularly, for example, for some of these newly constructed things, and those who haven't been following Opal Tower may want to know, that in fact the Opal Tower thing is not resolved at all. There are still about half of the units that are empty. And essentially, we now know that there are many other newly constructed apartments in and around our major centres that have got faults in them. The new building regulations coming in May won't necessarily solve that. So we're already seeing considerable falls because of the construction questions. Then we've got a lack of demand because a lot of units were being purchased by builders, by investors. Now that's pretty much gone now. Unit prices down because of construction issues, down because of lack of demand from property investors. And the other thing that's happening is that those in the sort of outer urban areas where there's a lot of construction, people can now afford to buy closer in. So effectively, we're seeing a lot of new properties for sale with nobody wanting to buy them. So that's why I'm saying that it could be a 50% fall for some apartment areas. And I'm looking at places in Sydney, like Ryde, for example, where there's a lot of cheaper property now and prices will fall further. And that then takes you into the whole debate about negative equity. And I'll just talk about that now. Negative equity is really significant now. In fact, I was involved in a program for 7:30 today. I recorded it today. They came down here and I showed them all the data, and they recorded some questions and answers, and even had me walking on the beach at one stage with a drone, so we'll see whether they use that. But the point about negative equity is that it is significant. Now, the Reserve Bank recently said that it's something like 2 or 3% of households, 2 or 3% of loans are in negative equity. But I look at it from a household perspective. And when I do that, And when I take account of the fact of the more recent house price falls and unit price falls, and when I take account of the fact that somebody could have an investment property and an owner-occupier property, and one or the other could be in negative equity, the count of people in negative equity goes up to about 10% of people owning property across the country. And that's a big deal. And negative equity is something that doesn't necessarily hit you immediately because it's a sort of a paper problem, unless you are forced to sell, maybe because of divorce or some other factor or illness, or if you are effectively trying to move. And what happens is you get locked into the property that you've got. If you look at Ireland and the UK, a decade after the crash, people are still in negative equity there. So negative equity is a really important factor, and it also puts a drag on the broader economy because people don't spend as much at the shops. They try to repay the loan a bit faster, and also reduces sentiment and enthusiasm for things, property and things, sort of retail. So there are some very significant issues ahead, in my view, relating to negative equity, and units in particular, because of this 50% forecast, are going to be very badly hit in my view. Okay, what I'm going to do now then is I'm going to go back to the Q&As. I did actually have some handed through to me, so I thought what I would do is just start answering a few of those, and I'll come back to the live stream shortly. So let me do this. So Hanny said, as someone thinking to buy in Melbourne as a first-time buyer, with all this talk of home prices going down, it's frustrating to see the 500, 700 range of houses going up in price. Northwestern suburbs like Burnside Heights, Sydenham, Caroline Springs, Taylor Hills are increasing in price according to realestate.com.au. Do you think the price falls in more expensive houses will flow through to these suburbs? Okay, now there's a couple of things to say here. Firstly, that data from realestate.com.au is somewhat old, so it may not be giving you the full story. And of course, it's an average situation as well. So, be careful about understanding where prices are. A lot of the auctions that are being reported at the moment include a sale, but don't necessarily include a value. And the value is not known for a couple of months, 3 months, because of the settlement processes. So that's the first point. The second point is, I'm seeing the spill down now of price falls. It started at the top end, it always does, but it's spilling down into the 500, 700 range. And that's partly because there's less capacity now for first-time buyers to get in at that sort of level, particularly if you are looking to put let's say, a 20% deposit down. And bear in mind that if you buy now at that sort of level and prices slide, you will start eroding your deposit. It's not equally spread between the mortgage and your deposit. You lose the deposit first. And that's what people, I think, need to understand, that if you buy too soon in a falling market, you can actually lose your capital, all that hard-earned savings that you put in. So my view is, if you're a first-time buyer and you don't need to buy now, it's probably worth waiting, because I still think the spillover will continue and more price falls will follow, even the areas that you're talking about. Now, Ian asked, securitization of home loans and mortgages by lenders, originators and banks has serious impact on the right attached to the original housing loan documents. Is this the biggest element in the housing room? Now, you're raising a very important point. In the documentation for every mortgage, there is a right of a bank to pass that mortgage document and the rights of the mortgage to any third party without your permission, if you're a mortgage holder. And so they package these loans up and pass them across, and essentially they also pass across the cash flows and the value in the mortgage. That's what securitization is all around. And there's a lot of securitization going on at the moment, interestingly, because there's quite a lot of appetite for it. Now, essentially that means that the ability to package mortgages is wired in to the Australian mortgage industry. And you as an individual mortgage holder have no control over that. It also means that if a bank fails, those mortgages can be passed across to somebody else, so you don't suddenly find that the mortgages no longer exist. It will exist because it's an asset. And there's an example in Ireland, for example, one of the Irish banks has just securitized a large pool of mortgages that actually were in default post the GFC, and they've now securitized those. So even later years later they're still valuable. So this is a big deal, and it certainly changes the whole complexion of the way the industry is likely to evolve, in my view. So Katrina said, enjoyed some of your vlogs, thank you very much. On bank bail-in, I'm not sure whether you're enjoying is right, but certainly, it's an important subject. A couple of questions. If governments across Australia use the Commonwealth Bank, will their deposits also be caught up in the bail-in if Commonwealth Bank were to fail? Or is the government an exception to bail-in? And if so, when then does that essentially mean the government could become a large shareholder of CommBank and therefore partially nationalise the bank? Okay, now the thing to say about the bail-in arrangement is very unclear, right? It's not clear as to precisely what types of deposits would or wouldn't. I'm assuming at the moment that it would be personal deposits and it would be small business deposits, but not necessarily commercial, nor indeed banks. So that's my sort of assumption. So I don't think your hypothesis is necessarily correct at the moment. But let's be clear, bail-in is very unclear. It's not totally clear whether it will happen or could happen. Everybody in the government and in Treasury says, no, we have no intention of bailing in whatsoever, despite the fact that the Financial Stability Board internationally has said that's what you should do. The IMF has said, Australia, you need to do better on bail-in. And, there are a whole bunch of other arguments. We've published a few of those more recently. And what it means is deposits are at risk. So a deposit is essentially an unsecured loan that you've made to the bank. And New Zealand is probably the best example of the bail-in regime in action. So there is an open banking resolution in New Zealand. It's very clear there that banks can be rescued by bailing in deposits. In other words, your deposits are converted into equity in the bank to help it survive before it fails. In Australia, much less clear. Some people are saying there's no intent at all to bail in, what Treasury says. My own analysis, and that John Adams and the CEC and a few others are saying, no, it's much, much less clear than that. And my argument is if people were really serious about solving this problem and didn't want deposits to be bailed in, they could have changed the law and made it really clear that that isn't the case. Currently, one, it's not totally clear, and two, the parameterization of what's in and what's out is completely mysterious because no one's ever spelt it out. And that's a big deal. Okay, let's go pick another one. This is from Scott. Is it fair to say that the CPI component for housing being defined as the cost of housing rather than the cost of a house is the root cause of all this mess? Housing CPI has remained relatively steady as mortgage rates have dropped and house prices have skyrocketed. If that component of CPI was a total cost, then in theory house prices would be better coupled to any wage movement in the real economy rather than the credit growth. Yeah, there's a couple of really good points there, Scott. The first is there is a sort of imputed housing cost. It's sort of like a quasi-rental that's used, right? But actually it really has very little significance and is completely disconnected from the true costs of owning a house because mortgages are a lot bigger than they were. Interest rates have gone up in some cases. So the CPI, as it currently stands, absolutely understates the cost of housing. As a result of that, the inflation is reported lower than it really is, which means that effectively the Reserve Bank may not be below its floor, and that means that perhaps it should be, not so worried about cutting rates to stimulate inflation. The other point there is that because CPI is very low, it means that wages growth has been very anemic. All sorts of reasons for that, not least the lack of ability to negotiate higher wages and people fearful about their job prospects. All those things are all part of the mix. But yeah, fundamentally, we are not alone here, by the way. This calculation is also used in other countries around the world too. But CPI and the CPI cost of housing absolutely understates the true costs for most households, particularly those with a mortgage account as well. Just going to look back on the live stream for a second and see what else we've got. And I'll do some more questions if necessary. Okay, Travelling Man 1980 says, where do you think the Brisbane unit market is at? Is it for further falls? Yeah, it is. Got to separate, I think, the high-rise developments in and around the centre of Brisbane and those further out. There's a lot of evidence that the high-rise construction is being slowed, and there's a lot of evidence of attracting deals to try and get people to buy them or to offer them and rent for 5 years and then buy later. developers are quite desperate to try and move them. But if you look at the asking prices, they're considerably down, 15 to 20% in some cases. I think we're going to see more falls there. Further out, where there is less supply of units, there's still some falls, but not as much. And there what you're seeing is that the outer rim, as it were, beyond the CBD in and around Brisbane is a little bit more buoyant because prices didn't go up as fast initially. But you're competing now with houses that are getting a little cheaper too. So I think those units are also in for trouble a little later as well. So more down, I think, than up is likely. And also note this, that the banks have actually started to ration credit, in particular postcodes, particularly for some of these high-rise developments, because they don't want concentration risk. And so in some cases, it's quite a lot more difficult now to get a mortgage on some of these properties than previously. Now, some of the developers are actually offering their own mortgages to try and encourage people to buy. But you need to look at those very carefully, because in some cases, the terms and conditions are less advantageous and their interest rate may be a little higher as well. So my view is Brisbane prices for units likely to slide. I think houses probably will hold their value a little better. Okay, Megan F. I'd love to see you guys do a video on the risks of bail-in. You should watch some of our previous shows. There's about 4 or 5. If you do a search on the DFA channel for bail-in, there are ones where we describe what bail-in is. We describe the New Zealand situation. We describe some of the things that have gone on with regard to the way that the Treasury and the politicians have tried to get around it. And if you go over to the Interest of the People channel, that's the John Adams and my channel, other channel, there we've discussed it more recently, and again there are issues. So there are some videos around. Okay, Jeremy C. Are credit unions different re-bail-in? Because I remember, don't think so. At the moment, it's hard to know for sure because there's such little information with regard to the bail-in processes. But generally, I think that they would be seen as effectively a deposit-taking institution with members, yes, but also with the same risks. So I think probably not. What I would say, though, is that credit unions generally are more conservative in their gearing and in their risk scenarios. So I generally hold the view that smaller banks and credit unions are less likely to get into difficulty relative to the majors. Although, of course, Bank of Queensland reported their results quite recently, and they were really pressurised because of the margin compression, because of their funding costs and other things. So you've got to be a little bit careful. But I do think that some of the biggest risks are those with the major banks who are very much deep into the derivative sector. And it's that cross-connection between derivatives, which of course has an international angle, as well as the mortgage sector and what's happening there. Put that together, and some of our major banks, I think, are in more difficulty than perhaps is fully recognised. Okay, Joe Wilkes says CPI neglected a 20 to 25% increase in Auckland house prices between 2015 and 16. RPA equals rich person's inflation, and CPI equals crappy person's inflation. Very good, yeah. That's about right, actually. Thanks for that, Joe. Okay, this is from Venko. There is a rumour that Westpac is winding up RAMS. Do you know anything more about it? Well, I've heard some of the rumours. Essentially, RAMS, of course, is a sub-brand within Westpac. It has its own distribution channels and its own products, but is more and more being subsumed into the major bank. And the securitization model I had previously is becoming perhaps less appropriate. So in a way, the whole reason for RAMS to be there is probably questionable. Secondly, of course, there are some questionable behaviour that we saw a few years ago in certain segments of Westpac, including, I think, RAMS, and that could be a thing. And thirdly, if the momentum in the mortgage industry is slowing, you have to find ways of cutting costs. And in fact, pretty much all of the major banks are looking to cut costs. So CBA is looking to cut 10,000 jobs, allegedly. ANZ is looking to cut others as well. So they're looking at ways to slice costs out of their business. And business units that don't necessarily generate a massive amount of return for them is an obvious way to go. So it doesn't surprise me. I don't have any inside information relating to it, but it could certainly be plausible. Okay, let's have a look. I think I missed one there, but I don't know. Okay, this is from KHYE. How do you pronounce that? Kai? If Labour win and scrap negative gearing, do you expect larger falls? No, not particularly. So I think that if you look at it in the round, the negative gearing changes that Labour are proposing, which is grandfathering the existing arrangements, and only allowing people to gear for new properties, not existing properties down the track, will have a small impact. Because what it means is that if you've got an existing property, that's not a new property, of course, and you want to sell it, then you have less people potentially who might want to buy it. So there is some potential for prices to fall. But in the scheme of things, with investors, withdrawing, and I showed that new loans is way down for investors, this is quite a good time to do it. This should never have been brought in. If you go back, 10, 15, 20 years ago when it came in, it was a nuts strategy, because what it has done, it's inflated house prices for everybody. So you are paying more for the property that you've got and your mortgage because of the negative gearing when it was brought in. And if you're a first-time buyer, you're competing head-on with people who get tax breaks from the government to be able to actually afford to buy more investment properties. And many investors have 4, 5, 6 properties, many of them with multiple negative gearing. It costs a lot of money, and it's inflated home prices. So if we're serious about trying to pull property back to something which is more sensible in terms of value, and perhaps property should be thought more of as somewhere to live than as an investment, then getting rid of negative gearing, I think, is a laudable aim, and I actually support the policy. There will be some minor adjustments, but nothing like the scare that's been put out by some agencies and bodies. And if you look carefully, a lot of the news reports, they're all to do with construction sector, real estate sector, or particular segments of politics. The fact is, the modelling that was done by Treasury, the objective modelling, shows very little impact of negative gearing. How long, this is from Raymond, how long do you think the government can prop pricing by over-importing immigrants to soak up bad internal economic policy? Big question. Okay, yeah, we have had for a generation plus massive migration coming into Australia. And if you look at the data, CPI data, for example, it's looking quite good because we've got more people. But if you look on CPI per capita, it's nowhere near as good, because we're not actually creating more value per person. We're just actually creating a bigger sum. And that's really the problem. Now, many of those migrants, when they come into Australia, don't buy property directly. They can't afford to, or they choose not to, and they rent. So there is a sort of connection to the property sector, but there's a much more direct connection to the fact that people find it more crowded, more difficult to get around, all those sorts of things. My own view is that both sides of politics are still on the immigration strategy, and we will see more immigration coming in because it's one of the few growth levers that they actually have. And even the so-called reduced targets that people are talking about are still quite significant. The problem we've got is that we don't have the planning in place to deal with the capacity constraints of this level of migration. But I don't think it's just property that's the key issue here. It's everything from water and those sorts of things as well. So there's a lot of reasons why my own view is that the migration policy should be thought about much more carefully. I don't want to turn it off completely, because I'm a migrant. I came here 25 years ago. But nevertheless, the fact is that if we actually keep the settings where they are, it's going to create a significant proportion of problems for the broader economy. And to be frank, I don't think it necessarily is going to solve the housing problem one way or the other. Okay, this is from Sean MC. If houses fall too far into negative equity, can banks enact a margin call to make up the difference in if you're making repayments on time? Now, good question. There is a force majeure clause in most mortgages which basically says if we decide to make a call on your mortgage, we can. But I don't think people will. I don't think the banks will, because they know that if they started to do that, then they would actually tip the market even further and put more pressure on households, and that's the last thing they want to do. Banks want people to continue to pay their mortgages for as long as possible, even if there is negative equity. But there is another question. If a bank knows there is negative equity in a property, it means that the risk in that portfolio is higher than previously. And if they know that, they should be actually putting more capital against it. So the real question you should be asking is, are banks marking to market, in other words, taking account of the new price falls in their existing portfolios? And almost no banks are at the moment. So many banks are still using the valuations that were used on day one when the property was actually written. And the only time it comes up is when a property is refinanced or a new property is written. So we've got this sleeping problem with regard to the negative equity problem. And I guess the banks are hoping that prices will start moving up and negative equity goes away. My own view is that's unlikely. So we need to start thinking about how to deal with negative equity quite soon, I think. Okay, this is from Jonathan. What do you think will happen to the satellite cities to the major centres such as Logan, Ipswich, Geelong, Wollongong or Newcastle? Yeah, those centres, I'm close to Wollongong here, those centres are always going to be under the gun when it comes to some of the situations. As the economy sort of eases back, you'll see that unemployment will rise faster in some of these locations. You'll see that home prices will continue to slide. They never rose as fast, but they will also fall. And mortgage stress is quite high in some of those areas. So, for example, Ipswich, mortgage stress is very high in there. And so we are seeing those satellite areas as potentially high-risk areas already. And they will be tending to catch a cold first if indeed the broader economy moves into negative territory, which is one of the reasons why I said I believe that some of those regional centres will see prices fall further. Okay, what else? Okay, Biber seconded Raymond's question, so I've answered that and answered yours then, that's good. Okay, this is from Emmeline. If homeowners fall too far into negative equity, can they enact a margin call? Oh, okay, I think I've answered that one already. Sorry. Theoretically, the auditors should force them to market this from E&H if they do their job, but that would seem unlikely. Yeah, well, it's interesting. So basically, the rules say if there is a material change in the portfolio, it needs to be reported on a continuous disclosure basis. Right? Defined material change is the problem. And so very often people will say, well, you know, the valuation is the valuation, people are still paying, so there's no issue. So we don't want to create more risks in the portfolio than there actually are. My argument is those risks are real because marking to market means effectively that people have less equity. That means there are higher risks, there's more risk of default. And also there are some interesting consequences for those with lender's mortgage insurance. What happens there when you actually go into negative equity? I'll leave that hanging because it does depend on the small print, but it's not without its problems. Okay. Now, John Adams. Hello, John, you're there. And so this is now the Christopher Joy story. If Joy won, why did he block me on Twitter? So there's a big debate, of course, as to who won the debate, the big debate with regards to... And basically, Joy's question point was interest rates are much lower than they were, therefore... affordability is much easier, therefore there's not a problem, right? Now, my argument on that is yes, but 30% of households are in mortgage stress, or 31%. The Reserve Bank said 30% of households, this is in the Financial Stability Report, have no buffer. So that tells me that a considerable proportion of the population is right up against it now. So therefore, I don't accept Joy's position that everyone's fine. The other point there, Joy did concede that if there's an external shock, then things could get nasty, right? So we can put that to one side. Will it or won't it? The question then becomes, what is the local economy like, really? Okay. And if you look at the Reserve Bank data, which comes from the Hilda data, which is 2 years old, or if you look at the Reserve Bank data that comes from their securitization portfolios, which of course are self-selected because by definition you select the low-risk portfolios into a securitization pool generally. What's interesting is that Joy, in one of his recent posts, highlighted the fact that a lot of the securitization pools were now at much higher risk than the Reserve Bank would recognise. So in a way, Joy's already saying there are higher risks in the portfolios than perhaps he's prepared to concede. So my own view is I think John's closer to the nail than Joy. And if there is an international crisis, be it the US, be it China, be it Brexit or something else, all bets are off, and you saw my scenarios and the consequences of those. Okay. This is from Indiana Jones. Will Bull Shorten raise the first home owners grant to 30k by December 2019? Interesting question. There is a temptation to do first homeowner grants to try and help people into the market. But all my research says it doesn't help at all. All it does is lifts all the boats in the harbour and makes price more expensive by the amount of the first owner grants. It's a completely stupid, dumb policy. There are other things that could be done, but that isn't a very good one. So I hope he doesn't do it. I'm worrying that when they get in and they see that the books are much worse than perhaps people thought, they will then have to do more stimulus. And I wouldn't be surprised to see more of the sort of 2007, 2008, handouts of cash and those sorts of things. And I wouldn't be surprised to see more first owner grant stimulus. But the first owner grant stimulus, in my view, is bad policy. Is the global slowdown in growth just because there is a lack of lending in investment, because banks are forced to lend for non-productive but safer stuff like property? This is from Biber. Yeah, so why is global growth slowing? Basically, there's three reasons. The first reason is that a lot of corporates are debted out. In other words, they borrowed big when rates are low and they bought back their shares, but they can't continue to do that forever. So there's a limit to how much they can do that. Secondly, consumers around the world are coming off. So if you look at the US, consumers are coming off here, they're coming off in the UK. And that's partly because income growth is a problem, partly because the ability of consumers to continue to consume, there's a finite amount of consumption that they can actually consume. And then the third thing is that the forward momentum in terms of future growth was partly to do with China and some of those other emerging markets. And we're seeing a lot of those markets now beginning to come off. So China's coming off and some of those other markets are coming off. And that's the problem, really, because the symbiotic relationship between Western economies and those emerging economies were part of the growth story. Because that's coming off, the growth engine doesn't really exist. So you can't get consumers to do it. You can't get international markets to behave. So where are you going to get growth from? And that's why growth is slowing. I don't think it's directly a consequence of lending, but part of it is lending. I have a real concern that there's been too much debt, and a lot of that debt has gone to property, but a lot of the debt has also gone to the corporate sector. What percentage of a person's income should be a maximum for a home loan? And what percentage of the current population risk defaulting in the next 30 days or so? That's from Yusuf. Okay, now that's very interesting. So percentage of a person's income on a home loan repayment is an interesting one. Generally, the rule of thumb was if it's more than 30%, you've got a problem. The other way to look at it is the income to price ratio. So, people could get a mortgage of, when I was writing loans years ago, 3 times the first income plus 1 times the second income told you the total loan that you could get. Now we've got people getting 5 times, 6 times, 8 times, 10 times their income, which is why the mortgages have been huge. So there's 2 ratios. One is the servicing ratio, which is the 30% rule, and the other is the multiple of income relating to the mortgage. And my own view is that both of those have gone way off the scale. I see a lot of households at 35 to 38%, even up to 40% of their incomes going on the mortgage repayments, which is too high. But I also see a lot of renters who are up 50% of their income on renting. So renters are also under pressure as well. In terms of risking default, there's not a huge number. So I model over 12 months, and I'm seeing 66,000 households over the next 12 months risking default at the moment. So not a large number, but enough to be concerning. But the point is that if employment goes the wrong way and so unemployment rises, or if interest rates were to rise, the highly leveraged households mean that those numbers will go up dramatically, which is why I'm forecasting higher mortgage stress, higher levels of default. But, it's manageable at the moment. Okay. No such thing as everlasting growth, says Megan. Yeah, that's a very interesting question. So, in fact, I think one of the questions I've got, which I may go back to if I've got time, was on this question of, is it sensible and realistic to continue to grow forever? Or do we need a different strategy? I actually think we need a different strategy because, by definition, we're going to run out of finite resources on this planet, one way or the other. And whilst we can be innovative and create new things and new ways of doing things, eventually there will be a limit beyond which we cannot go. And I personally think that we need to find an alternative strategy that is not growth dependent. Maybe there are other measures like quality of life or other factors rather than just the CPI growth. And the CPI is a very poor measure of anything, actually. It doesn't really tell you much. As Eddie Hobbs said the other day, prostitution is actually in the CPI number. Well, that's an interesting comment. The fact is that anything that's creating activity is in the CPI number, but activity is not necessarily value adding, just running faster. So my view is we need a different economic basis from the one that we've got. And both sides of politics are selling us the same old dope, frankly, and that's a problem. Thomas, this is your point, isn't it, about infinite growth and infinite finite resources. So he suggests, and I think it's a good idea, what about an ecologist and an economist talking about this fundamental question? Yeah, I think that's an area that we should explore in a future post. So thank you, Thomas, for that. It's a good idea. Amit said, I noticed a bit of a strange pattern where the mortgage lending environment, hoping you could touch on it. So this is about the number of banks have dropped their rates on some fixed interest products than others. What's happening? What does this indicate? And effectively, what do we see later? So, if you look at the 4-year rates, they're a lot higher. Yeah, so banks are taking a window of opportunity at the moment because the funding costs have come down. They are desperate to get new business, and they're offering those new loans to new borrowers to try and get people through the door. They're probably doing it for that reason rather than a longer-term view. But if you look at the interest rate scenarios and the yield curves, the suggestion is that effectively our rates are going to be low for quite a long period of time. As you go further out, of course, there's less certainty about it. So that's one reason why you tend to find that rates further out are sometimes a little higher. But I should warn you that the concept of an inverted yield curve in Australia, which is conceivable, bears very little relationship to recessions or anything else. So to my mind, doesn't give you a very good handle on what's going on. But banks are cutting rates on fixed rates because they've got this window of opportunity and they're desperate to try and write business because mortgage business is the only game in town. Okay. Now, Jean says, the Senate will be reporting on banking separation on the 16th of May despite the election. What does this say about the process? And are we just going through the motions? Yeah, in short, Jean, great question. Yeah, we are. There'll actually be a post that Robbie Barbick and I recorded today, which will go up later, where we discussed the fact that the Senate is essentially running its process. There were more than, nearly 1,000 submissions to the Senate inquiry into banking separation, but they're going through the motions in terms of creating a pretty boilerplate report, and it'll be released on the 16th of May despite the election and everything else, which basically says people are not serious about this. But the good news is we can still, through the election cycle, ask our elected politicians and those who would like to be elected politicians about banking separation, about bank bail-in and those other things, because they are going to have to confront those issues. So what Robbie and I said in our post today is ask the questions and make sure that this doesn't get swept under the carpet, because this is still a big deal. And Glass-Steagall is an important step of separating out some of the risks. It's an antidote to bail-in. Watch out for our video on that that's coming very soon. Okay, I think just a couple more questions. How safe do you consider the cash option with industry super funds, given the potential for bank bail-ins and problems with bond markets? Is it better to be diversified? It's an interesting question. So what I would say is that funds in a savings option within a super fund, like bonds won't necessarily be caught by bail-in. It's sort of personal deposits, I think. But again, it's very unclear as to precisely how this plays out. Excuse me, it's lemon nose. Generally, I think the recommendation is spread the risks and diversify. But of course, you've got to think about what those other risks are. If you're in the stock market and the stock market is very high at the moment, if it comes back, that could be a problem. The superannuation sector, in my view, is highly exposed to property, it's highly exposed to the finance sector, and it's highly exposed to cash. So there is no guarantee that the superannuation sector is going to survive and thrive, and in fact some people are seeing returns down between 3 and 5% relative to last year. So don't think of the superannuation as sort of separate from the broader risks in the economy, but I don't think it's as simple as saying go diversified or not go diversified. Last point is ask your super fund specifically with regard to cash, how they hold the cash, and bail-in, and see what they say. And report back. I'll be interested to see what they say. Now this is from British. The agents are window dressing the auction results in recent times as a proportion of scheduled auctions are being underreported and thus propping up the percentages. Can you make a video on historical data? Yeah, so I showed you some data earlier on, which is quite important, that in fact the auction clearance rates are actually quite low, about 50%, but the volumes are way down. But it is rather fictitious insofar that a lot of the auctions that never go through are just disappearing. And that means that the true clearance rate is significantly lower. So you're spot on here, and there are many estate agents who are spruiking a recovery in the property market thanks to these auction results. My argument is it doesn't exist. And there you go. I got your question from earlier on, Joseph, so I've answered that earlier on. Okay, so let's go back. It's 9:25, so we're nearly coming to the end of the show. What I will do is just go through a few things here. So just in terms of, I'd make this sort of comment every time. We do this not because we are generating massive amounts of income from doing it, but because we really are serious about helping people to navigate the complexities of the financial situations given all the uncertainties. But we do rely on support via Patreon, and you can actually support. If you do support us, you can get access to some additional content, and basically there's a sort of a subscription service and different tiers. So have a look at that, and if you haven't supported us, consider it. And if you have supported us, I really appreciate it. It makes a huge, huge difference to our ability to be able to continue to make great content. Or if you want to make a one-off donation, you can via PayPal, and that's much simpler. Just you can send us whatever you want. Again, hugely, hugely important to enable us to continue to do the research that we do. Basically, I'm doing less client work, and I'm spending more time developing this content and delivering it to the YouTube channels, thanks to your support. So the more you can support us, the more we can do more. There's a DFA blog, of course, which contains a whole lot more data, and I keep saying to people, go across there. You can subscribe to get all the updates as well from the DFA blog. We put up several posts a day. We also cross-link all of the YouTube videos as well. We've got quite a few people following us on the blog, so have a look at that. And you can also send direct messages to me there as well. Just in terms of some top hits, there's just a few to highlight. The IMF report that we did, that was really an important report because it highlighted the fact that the truth of the matter is that household debts is a problem in Australia. So that's quite important. We do our property imperative weekly reports on an ongoing basis. And, that's probably the biggest thing we do each week. I used to get a lot of people saying, thank you, it's long, involved, complex, but we love it. So we're going to continue to do that. But, if you think that the property imperatives is of less use, tell me, because I can spend the time doing other things. There was a post I did with Joe Wilkes on debt, divorce and death. So these are people who have to sell regardless. And that's quite an interesting phenomenon at the moment, and both for real estate sector and also for those who are in that situation. Over on the Interest of the People channel, we highlighted the fact that maybe the economic Armageddon, in other words, the crash, may start in Australia rather than being impacted by an international situation. John Adams and I discussed the fact that it may start locally. And if you haven't subscribed to In the Interest of the People, do that, because that gives you access to John Adams and my specific comments. I also discussed the property market with Chris Bates. I mentioned him earlier on. Chris is quite an interesting guy when it comes to thinking about the property market and talking specifically about some of the issues and challenges of people willing to buy. And the last one there is the negative equity trap, which is my discussion specifically around the Reserve Bank's comments with regard to negative equity. And I compared it then with some of the work I'd done earlier on. And that is material which is being featured on 7:30 in the next couple of days. So watch out for that. I think it'll be quite an interesting discussion. And we'll see what they did with my data. So you might see some more heat map charts of negative equity ahead. Just quickly on Harry Dent. So you know that Harry and I did a show a couple of weeks ago. I don't necessarily agree with Harry on a lot of things, but he's an interesting guy to talk to because he is thinking about, the potential big fall. So if you're interested in learning more about Harry, you can. He's coming to Australia. These are the dates. And there is the ability to be able to actually register for his events. And I think there are still a few complimentary tickets available. There's a link there. I'll also put it in the live event below so that you can actually go there if you want to do that. I get nothing from this. I don't necessarily believe or support Harry's views, but I think he's interesting. He's quite entertaining. And I do think that some of the interesting things that he says make you think. For example, Harry's sunspot theory is one of the cyclical influences on what's going on. But his comments about demographics, and particularly how Australia is placed demographically speaking, I think are really quite interesting. Just doing a quick last look and see whether there are any other questions. I'm still figuring out Harry's sunspot, says Robert Barwick. Yeah, I know, Robert. I don't know how it works, but we can always ask him when he's here. It might be quite interesting. I may interview him while he's here again. We'll see. Okay, so Ben asked, should super be moved to cash or defensive position in the interim and save the capital for coming crash, and then move back to higher risk? Yeah, so there's an interesting question there, Ben. The fact of the matter is we're in a high-risk situation. So I think you've got to ask two questions. How do I protect what I have? And then secondly, can I find a growth strategy beyond it? I think if protection is where you're at, then, moving towards cash makes a lot of sense. In fact, without disclosing too much about my own position, that's what I've done. I moved into cash quite some time ago because I felt there was too much unpredictability about the other markets. Stock markets have been running high, but they will come back at some point. We don't know when. A lot of the other strategies that people talk about, gold and Bitcoin, I think are surrounded with issues too. So, yeah, be a little bit, cautious, I think, at the moment. But also bear in mind that, as with all of these things, it's highly unpredictable, right? There could be a recession 3 months' time. It could be 3 years. House prices could go up again. So, watch for the signs. Keep watching our shows because we'll try and highlight when we start seeing the change in the wind. And if we do see the change in the wind, and if, in fact, prices start moving up or household opinions start moving positive, you will be the first to know. So that gives you a bit of early warning. Okay, Shiv's asked, will Brexit impact Australian banks? At the margin, possibly. Some of the international banks that are operating here, potentially, yes, although many of them, of course, are actually not really connected directly to the UK. They are actually in Europe. I think Brexit will have a minor impact on Europe. It'll have a major impact on the UK, depending on how it's sorted out. But it's not going to get sorted out anytime soon, where they've got down to October to work it out what to do. My view is they'll probably muddle on for even further. So we'll see. Okay, well, it's coming up to 9:32, so I guess we've pretty much... TNT Transy 2012 asked, where do you see the Aussie dollar heading? I still think the dollar's going to go lower. I still think it's going to be 60-something ahead. It's being supported a little bit by some of the changes with regards to the Fed because they're not putting the rates up there. But nevertheless, there are a lot of questions about the local economy here. And bear in mind, of course, we're also very reliant on China. So if China really continues to come off the boil, that will have a significant impact on the exchange rate. I also expect the Reserve Bank to take the rate lower to buttress the economy and to help basically deal with some of those issues. So that's why I'm thinking lower ahead. Bear in mind, of course, also that if the exchange rate drops, you'll be importing inflation. That could put higher pressure on the local economy in terms of inflation. That might help the Reserve Bank deal with some of the questions about the 2 to 3% band for inflation, despite the fact that we said earlier on the CPI numbers all over the place. Okay, so I think that's pretty much it. Just a quick last look. Yep. So I just want to say thank you very much for spending some time with me. I hope you found this a useful and interesting and informative session. As with all of this stuff, there's always more to talk about. There will be more articles coming up. There'll be more shows coming up. I've got more planned with John Adams, and I've got some other guests coming up soon. So continue to watch this space. I appreciate all your support, all your messages. Thank you for those who are sending specific pieces of information to me. I'd really appreciate those. I've had a lot of information with regard to bail-in, for example. That all helps me to triangulate what's going on. And if you have specific questions, you can always send them to me, and I'll either answer directly, I'll answer via a blog, or in one of these Q&A sessions. So I hope you found this useful. Thank you very much for spending some time with me. And I look forward to seeing you in a month's time, when we will know more about this wonderful economy and what's happening, and where house prices are going. So this is Martin North from Digital Finance Analytics, signing off. See you next time.